This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Now, what we've seen so far in our studies of capital allowances is that expenditure is classified as regards what's available for AIA, what thereafter may be available for WDA, or separately what is available for FYA. All the rates and allowances are provided to us on our rates and allowances page within the examination room. Any expenditure that we've not been able to get AIA or FYA on, that therefore is eligible for and will claim writing down allowance, has been allocated to either of two pools, they being either the main pool, upon which we can claim 18% annual writing down allowance, or the special rate pool, on which we can claim just 8% writing down allowance. What we're about to see on this next section of Chapter 5 that we're dealing with, and you can see on your screens on your notes in front of you, is that we may, and very often do in exam questions, deal with the purchase of what are classified as non-pool assets. So when purchased, they do not go to the main pool, they do not go to the special rate pool. If there is WDA to be claimed, and there usually is, then it will have its own separate column, on the face of the computation. Now then, there are two types of asset that we may have to deal with, one of which is way more important than the other, and hence the one that we'll deal with first. And that, as noted here, assets with private use by the business owner. Assets with private use by the business owner. So the sole trader or a partner within the partnership, an owner of the business. What we will see, and is separately noted down here indeed, is if we see private use of an asset owned by the business, but it's private use by an employee, that will not impact in relation to the capital allowances computation, and such expenditure can be allocated if not otherwise eligible for AIA or FYA, as we keep saying. If it's going to be WDA on some or all of the expenditure, then that will go to the main pool or special rate pool. So only when we have assets with private use by the proprietor. So let's just go through the details of this. Again, it's a regular inclusion within our exam questions. Private use of an asset, again we repeat, by the owner, the proprietor of the business. Again, we highlight it there, by the owner. Again, we know who it is, sole trader or a partner in a partnership. And where we have the situation where the use of the asset is partly for business, which is fine and therefore allowable, but partly for private purposes. Now, I kept on going on about a writing down allowance being the most likely asset allowance that you'd be looking to claim, because typically we're dealing with a motor car, and a motor car that has emissions in excess of 75 grams per kilometre, and therefore we would only get writing down allowance on. Far and away the most likely and the most popular asset for inclusion here for private use by the proprietor. A car with emissions of more than 75 grams per kilometre being used at least in part for private purposes by the owner of the business. If that is the case, as you might again assume, only the business proportion of the available capital allowances will be given. Now what this will mean is we'll still compute the normal writing down allowance. Whether that's 8%, whether it's 18%, we'll compute the normal writing down allowance. And that figure, that normal allowance, will be deducted in this individual column for this particular asset. It'll be deducted. So the full amount is taken account of in determining the tax written down value on this asset to carry forward to the next accounting period. Now, although you reduce the cost by that, the tax written down value there, by that full figure, you don't get to claim the full 8% or 18%. We restrict that to the business use proportion there. So only the business proportion of the available capital allowances will be given. The proportion is computed by reference to the percentage of business use to total use, and again, that figure is likely to be given to you. You may have to work it out for yourself, but there would be something like, on a car, you would be told, like we were when looking at motor expenses in adjustment of profits, you would be told, say here is the total mileage, 10,000. Of that total mileage of 10,000, 8,000 of that was for business. So 8,000 out of 10, 80% would be the business use element. That's any sort of work that you might have to do here. Otherwise, you'll simply be told what the business use proportion or private use proportion was. Now again, watch the way they give you the information. What we need to know is what was the business use proportion, because only that will be available. And we'll set indeed the column up on our computation headed with the amount of business use of that asset that there is. So if in the question you're told that this asset has 20% private use, then it's the 80% business use that is the important figure that we'll be able to claim upon. Okay. The cost, as we've said, is not brought into the main or special rate pool, but it's going to be the subject of a separate column on the computation headed up in the name of this particular asset, whatever it is. The writing down allowance, much the most likely one, or otherwise AI, AIA or FYA of the asset is calculated on the full cost. The full figure is computed, but only the business proportion of any allowance is actually given. So it's only the business proportion that ends up in your right-hand column, the allowances available column there. The other issue, that when you have such an asset, it may be one that you purchased during the period, but more often than not, what they test you on is that you're told at the beginning of the question that the tax written down value on such an asset is this. It's its own special item, not in the main pool, not in the special rate pool, in its own pool, all on its own there. And you are told the tax written down value. What then happens is the asset is sold during the accounting period. Now, normally all we do is to just deduct proceeds to a maximum of original cost from whatever our pool balance was, and then continue with our writing down allowance. If this individual asset is now being sold, then we're going to mop up any remaining capital allowances that may exist on that asset during this period. Once the asset is sold, it's going to be cleared from the capital allowances computation, if it is this non-pool. Anything we've identified individually as such a non-pool asset, then if it is sold, what we call a balancing adjustment will arise, which will clear up any outstanding allowance that might be available, or indeed will claw back in the case of any excess allowances that we have been able to claim, given now what the sales proceeds are on the sale of this asset. It's a balancing adjustment. That again is something new to us. So on the disposal of the asset, balancing adjustment is computed by doing what? By deducting sales proceeds, remember, to a maximum of original cost, from the tax written down value of the asset. That is your opening figure given to you, your opening balance. There is a balancing charge if the sale proceeds exceed the tax written down value, and a balancing allowance if proceeds are less than that tax written down value. Having computed the balancing adjustment, it is known either charge or allowance. Having computed, the amount assessed or allowed is then reduced to the business proportion. So if you've got a balancing charge or balancing allowance, the figure to go into your allowances column as either a negative, a bracketed figure if it is a balancing charge, or a positive inclusion if it is a balancing allowance, the figure to be included is the business use proportion. We restrict to the business use proportion. While we owned it, any WDA restricted to the business use proportion. When we sell it, any balancing adjustment restricted to the business use proportion. A balancing allowance, if you have one, is added in the capital allowances. So in your allowances column, you add in the balancing allowance of the period. Whereas if it was a balancing charge, that will be serving to reduce the other capital allowances, so you put it in as a bracketed figure in your allowances available column. It would reduce those other allowances. If it happened that a balancing charge exceeds the other allowances available, not that likely, but if it were to happen, then the net balancing charge for the period, rather than reducing your tax adjusted or being deducted in deriving the tax adjusted trading profit, capital allowances reduce profits, but here you'd have the opposite to that, a net balancing charge. So what it would do is to be added to the adjusted trading profit of the period. It would be added to that figure. As we've already made mention of, private use by an employee of an asset owned by the business has no effect. Now, they often put this in to see whether or not you pick up on this point. Now, this is the worst kind of mistake to make in the exam room, because what it means is you go off and do relatively lengthy, slightly complicated exercise there that you needn't do. So you're spending a lot of time getting it wrong. You really don't want to be doing that, because not only do you not get any marks here, it means you're using up time that you could have spent elsewhere where other marks could have been earned. So make sure you read that question very carefully. So no effect on the business's entitlement to capital allowances. So if it's private use by an employee, you still get the full available allowances. It's for that reason, not that we yet know it, but when we come to companies and deal with the capital allowance computation for a company, it's going to be a little bit easier than you see here for the unincorporated trader, because in corporate tax, there's no private use adjustments. There's no private use adjustments in the adjustment of profits, and there's no private use adjustments when we deal with capital allowances. A whole area of the unincorporated trader, which gives us difficulties, problems here, simply doesn't exist when we look at corporate tax. Though again, they'll try to tempt you by telling you about the amount of private use by a director of the company. A director is an employee. Like any other employee, it has no impact on capital allowances. They are still available in full. The fact that, for example, the company, the business, may be providing an employee with an asset that is available and is used privately as well as for business, well, that is an issue that for the employee that will be dealt with when we determine the employee's employment income assessment. So in Chapter 9, what we'll see is the receiving end of this. The employee who's provided with this asset, typically again a car, that is picked up, it's dealt with within the tax system, but in the income tax system, where an assessable benefit will arise in relation to the use by the private use by the employee of that particular asset. Again, I say usually a car, and that benefit will be assessed and charged to income tax. Here, in our capital allowances computation, there's no effect, no adjustments to be made. Okay, with that in mind, therefore, let's just roll the screen over to the next page, where, as luck would have it, we have example 2 to now deal with. What do we need to do? Calculate Jane's capital allowances for the year ended here, December 16. So again, important, we now know it's a year ended, which means full 12 months worth of AIA and WDA, no time apportionments required there. What are we told? Jane, as we already know, prepares accounts to 31st of December, but we're told at the start of this accounting period, written down values brought forward are as follows. Main pool. So we inherit a main pool figure. And then motor car, 115 grams per kilometre, use 30% for private purposes. by Jane. Jane is the proprietor, and on that basis what we've got is a non-pool asset. Here we are told that in the past Jane purchased this particular car and we've got this 30% private use, therefore 70% business use of that vehicle. That's going to limit our capital allowance, and it means it's not main pool, it's not special rate pool, it's got its own individual column. Although it doesn't go to a pool, still important to know what the CO2 emissions were. Because again, based on what we already know about CO2 emissions, that will dictate whether it's 18% or 8% WDA. As that's 115 grams, that means we'll be talking about an 18% writing down allowance being available. But it's a non-pool asset, it's got its own separate column. So immediately, in terms of the computation that we're going to have to structure, there's two columns that we're going to need to have, let alone our AIA/FYA column and our allowances column. So what else have we got in terms of what's happened during the period here? Purchase plant for £6,600. Normal item of plant, AIA, will be available. Then we've purchased a car, 10,600, CO2 emissions 100 grams per kilometre, to be used by an employee. So do we care what the mix is between business and private use? No, we don't. It's by an employee. So it just, as we've seen before before we knew anything about private use by a proprietor, we're buying a car, 10,600, emissions 100 grams per kilometre. What does that mean? It means that WDA will be available and that it's a main pool item. WDA, it's a main pool item. We then sold the motor car used privately by Jane for 9,400. So that motor car there that we are told we started the accounting period with a tax written down value of 13,600. It's sold off during the period for 9,400. That is going to give rise to a balancing adjustment, and because there was private use, 30% private, 70% business, we will restrict the balancing adjustment to 70% the business use proportion. Finally purchased a motor car for £16,000, CO2 emissions 180 grams per kilometre, used 30% for private purposes by Jane. So she sold her old car and bought another one. In terms of the emissions, 180 grams, that means that any writing down allowance available here will be just 8%. But it's got private use by Jane, so again it's non-pool and will require its own separate column. All right, having read through all that information, a lot going on here, we now need to set up our capital allowances computation. And on this one, we're going to need a lot of room. There's going to be a lot of columns that we need. We know that we do have expenditure during the period that attracts AIA. So we're going to need an AIA column. We also know, we're told that we inherited at the start of the period anyway, that we've got a main pool. So we've got our main pool to bring in. We also inherit at the start of the period car 1, shall we call it, that has 70% business use. There will also be, it was acquired partway through the period to replace car 1, car 2, which also had 70% business use. And of course, finally, as ever, our column to record the allowances of the period. So there's a lot going on. What period are we dealing with? It's the year ended 31st of December 2016. What do we pick up first? any tax written down values brought forward. Looking at the information in the question, what tax written down values do we have brought forward? You put those in. Do we then have any additions that qualify for AIA? Yes, we do. So you deal with those. Were there then any other additions? Other additions that will therefore rank for writing down allowance? Yes, there were. We were talking about cars here. Do we have any disposals? Yes, we do. So there will be less disposal. Sales proceeds to maximum of original cost. And once that's been dealt with, then we can establish any writing down allowances available and any balancing adjustment. We don't yet know, though we could actually work it out with the figures we've already been told, what that balancing adjustment will be. We'll come back to that later. Okay, so going back through the information in the question, if you make sure that you can see that for yourself. The main pool tax written down value brought forward was £21,200. Car 1 that we had at the start of the period with the private use by Jane had a tax written down value of £13,600. So that's what we've inherited at the start of the period. Do we have additions that qualify for AIA? Yes, we do. We had an item and plant there purchased during the period at a cost of £6,600. And on that, we'll get our AIA of £6,600. Nothing, therefore, as a residue to go into the pool, and there's your first allowance to record, £6,600 in the allowances available column. Other additions in relation to WDA, we've got some cars here. Now, we had 2 cars based on the CO2 emissions. It's at this point that I think I probably haven't given myself enough room. Thankfully, of course, for the miracle of modern technology, look what I can do. But let's have a little go at then including what was here, the car with 100 grams per kilometre. That one cost £10,600. That was the one that we purchased there on the 25th of June 16, and we know that although it had private use, it was by an employee, so that has no effect. And we've already noted next to it that it was a main pool item. The cost, we said, £10,600, and therefore we allocate that to the main pool. £10,600, in it goes. We then had another car purchased that had 180 grams per kilometre, and very sensibly here Jane has got that car for herself. That was the one that cost £16,000. That's car 2 with only 70% business use by Jane. So in it goes, got the right column there, the right row, and that we said was £16,000. So we've recorded here all of the additions that have occurred within the period, and anything that was attracting AIA, we've claimed that AIA. What we've then got to do, of course, before we can calculate our figure of writing down allowance and any balancing adjustment, we've got to deal with the disposal. So less the disposal. What were we told in relation to that disposal? Sold the car, used primarily by Jane, for £9,400. Now, given that the tax written down value, which is the original cost less the allowances taken to date, is £13,600, very obviously those sales proceeds are way less than the original cost. So it's the proceeds now that need to be deducted here. What were those proceeds? £9,400. £9,400. So let's see what balances we have got. Oh, don't need that for the allowances, of course. We're going to add that up at the end. So in our main pool, we inherited 21,200. We've added in the car costing 10,600. That therefore is £31,800. Car 1 of the private use cars used by Jane was sold for 9,400, take it away from 13,600. That therefore is going to leave us a balance of £4,200. Car 2, just the cost of 16,000. Having got those figures, what now will happen? In relation to our main pool, we will be able to get our rating down allowance at 18%. So on our main pool, 31,800, we will take our 18% there. Now again, you put that through your calculator, do that one in our head. Writing down allowance, 18% of 31,800. I'm going to cheat for one moment here and see what that figure comes to, which would appear to be, better check it, knowing my mental arithmetic, when I did this, £5,724. 5,724. And of course, the 5,724 is listed out within your allowances column. So normal rules, what do you get on the main pool? 18%. It's a full accounting year end, so you get therefore the full 12 months worth. There's your writing down allowance. What we've also got, of course, is a balancing adjustment in relation to the disposal of the private use, the 70% business use car 1. Now we see that it has been sold for 9,400, so it's been sold for less than its tax written down value. Now if you need to, go back to your note, look at what happens where this asset is sold for less than the tax written down value. That gives rise to a balancing allowance. It means that we've not yet had all of the allowances that are available to us in relation to this. We've written it down to 13,600, but we managed to sell it for only 9,400. So the 4,200 is here to be deducted to close off that particular part of the capital allowances computation. However, do you get to claim this balancing allowance in full of 4,200? No, we don't. The balancing allowance is restricted to the business use. There's your business use, 70%. Times 70%, again I'm going to cheat, bear with me for a moment, is, what is that? Oh, the eyes are not as good as they used to be. That will be £2,940, apparently, 2,940. So we've dealt with the main pool, we've dealt with the disposal of the first private use car, but then of course there was the replacement, 16,000. £16,000 on a car that had 180 grams per kilometre. So what level of writing down allowance would we say is eligible on that level of CO2 emissions? And it is, of course, a mere 8%. 8% on 16,000, again, use your calculator, calculate what that comes to, and that would appear here to be, what have we got? Hang on a minute, can't read it. £1,280. Let's check those numbers. 1,280. But remember, it's got only 70% business use by the proprietor. So what are we going to do? We've got to restrict that allowance this period to whatever is the business use proportion, times 70%. And when you take 70%, therefore, of that 1280, apparently, I computed, let's say if it's right, that to be £896. Now, at that point, of course, we can compute what tax written down values there are to carry forward. I'm not going to bother with that. Clearly nothing there. But again, you'll see those figures in the answer in the back. What, of course, would be more important, and you need to do in your answer, is to calculate what this total of allowances comes to. Add down, get that figure. That is then the figure that you would use to deduct from to reduce the adjusted trading profit for Jane's business for the year ended December 16 in calculating her tax-adjusted trading profit. Okay, I suggest therefore at this particular point in time that you have a good look through what we have done, go back over these examples, make sure that you are happy with them before we venture further in terms of our studies of capital allowances. The next issue that we'll see, which you can probably see at the bottom of your page of notes there, the main category of non-pool asset that exists is absolutely and most certainly the private use assets, the private use by the proprietor. To a far lesser degree, and has become less important as the rules have been changed and amended over the years, we've got a category of asset known as short life assets. Again, there's a lot of notes that relate to it, but it's a relatively small area. I can't say it isn't going to come up. We never say something won't come up. But you don't start worrying about it until you've dealt with all of these other way more substantive issues. So before you click to the next lecture, go back over what we've done, make absolutely certain that you are okay with those areas, because that is the vast majority of anything that you might ever see in an examination question. Make sure you're comfortable with it, and if you are, you're in a very good place indeed. But then we'll come back and hopefully finish off most of the remainder in our next session together.